Hello and welcome to a brand new episode of Smart Money. Now today on the show, we will discuss how to invest in a rising rate environment. As we know, inflation is increasing globally. In fact, last month, the inflation in the US was the highest in the last 30 years. Not just that, the bond buying program is expected to be reduced. Hence, that may lead to a rise in rates globally and a rise in the dollar. Now, theoretically, that is negative for the equity markets. So how do you approach it in 2022? Joining us on the show today, we have Kirtan.shah, the founder and CEO of Credence Wealth Advisors. Kirtan, thank you so much for being with us on Smart Money. Now, for the benefit of our viewers, if you just want to start by telling us what has happened over the last 21 months globally and, what is the setup that we're in right now?
Sonia, thank you so much for having me on the show. So Sonia, typically all of us know that when there is an economic crisis like it happened in 2008 or what happened 2 years back, the easiest way that the central government or the central bank really has to, kind of stabilize the economy is to reduce interest rates and infuse the market with a lot of liquidity. And nothing new happened this time around. But the only change was that the kind of liquidity that we saw coming in 2008 during the Lehman Brothers crisis, this time around the liquidity that was poured in was 4 to 5 times more than it was in 2008. So there was a huge amount of liquidity that was infused in the market and would end up chasing assets. Now the bigger problem here was that along with the liquidity that was infused, rates were also brought down to zero. So now there is so much of liquidity in the market, rates are close to zero, there is hardly any fixed income kind of investment opportunity available. So this money ended up chasing gold and equity, which is why we saw what happened to gold and equity over the last 20 odd months.
Absolutely.
Now, also, while so much of money was printed, so much of liquidity was made available, typically you would see dollar falling. And that's exactly what happened, is because whenever there is so much of liquidity in the dollar currency available, dollar would typically fall. And this is a very sweet spot because of which a lot of money flew into the emerging markets, right? So what typically we saw over the last 21 months was a lot of liquidity made available in the market. Rates were very close to zero, and hence fixed income was not a good opportunity to invest in globally, right? Which is why a lot of this money started flowing towards gold and equity.
Okay.
A lot of this money came to emerging markets because dollar fell, and that's a good investment opportunity for foreigners to invest in emerging markets, and which is why we saw what we saw: equity go up, gold go up, and rates fall.
Sure. So Kirtan, that was what happened up until now, right? But now things are changing a bit, as we know. Inflation is a big concern. The dollar is rising. Do you think that this is the time to get a bit risk averse? And if you can just, first sort of set the background for us. What exactly is happening now on the rates front and how does one approach it?
So Sonia, what typically happens is when you fill the market with so much of liquidity, and thanks to COVID, there were a lot of supply side constraint also. Both of these things put together would lead to higher inflation. Now, so far what was happening is global economies or global central banks were not willing to accept that this inflation was about to stay. Everybody was making a comment that this is more transitory in nature. But what we've seen, and taking a cue from what you also mentioned at the start of the show, what's happening is that inflation globally is on the rise. Like you rightly mentioned, in the US also what happened is the inflation CPI number that came out were the highest rise over the last 30 years. Even in the Eurozone, if you look at it, before we moved into pandemic, the CPI there was 1.4, and now the CPI in the Eurozone is 4.1. And similar is the case in India as well, where the CPI is increasing. So what is happening is now globally, even the central banks have started accepting that this inflation that they initially thought was very transitory in nature is about to stay here. And hence you've seen, not just in India, but globally, central banks taking a step. To quote a couple of them, what has happened is in the US, we saw in the last Fed meeting where Fed came out and said that, inflation now is going to slowly become an agenda that they are going to look at. And they started, reducing the bond buying program that they were in. So they've already reduced the bond buying program by $15 billion every month. And if I'm not wrong, reading the latest commentary, I would like to believe that probably this bond buying program is going to slow down even quicker. right? So even the new virus that came in, because of which there is anticipation that probably the increase in the rate scenario will get pushed back a little more, but you don't read that from the Fed commentary.
Sure.
Also in India, if you
Kirtan,
look at it very closely, RBI in the last monetary policy did mention that they've stopped Operation Twist. They've also stopped the 𝗳𝗍 program. And they've also started conducting the 7-day, 14-day, 20-day, 28-day, variable reverse repo.
so Kirtan, let me interrupt you here, because, I mean, we do know that in the past, whenever there was an increasing yield situation, equity markets have not really reacted that well. This time around, what is your expectation, and how does an average investor, I mean, someone who's watching you right now, how does he read into it? What should the biggest takeaway be?
So, Sonia, I think, in my opinion, what we really have to understand is theoretically increase in rates or increase in yields are negative for the markets, right? Multiple reasons why that would happen is because if yields go up, a lot of money gets attracted towards fixed income. When yields start going up or global economies are doing well, dollar would do well, and hence FIIs inflows in emerging markets may not be a very prominent case. And also consumption takes a hit and capex takes a hit when you typically have interest rates going up. And which is why theoretically rates going up may not be a very good sign for equities market. But what historical data point, Sonia, shows us is that rising rates or rising yields may not necessarily always be a problem, right? So if you look at April 2004 to July 2008, when yields went up from 5.12 to 9.33, you still saw markets giving you a 23% CAGR. Similar thing happened in December of 2008 to October of 11, where yields went up from 5.3 to 8.85. You still saw a 21% rise. And similar case you saw in November 16 to September 18. But the difference is that in these three cases, when the yields were going up and the markets were also going up, the reason why this happened is that with increase in yield, it did not really end up impacting the earning yields for the Nifty 50 companies largely. So what I'm trying to say is that, yes, theoretically, when yields go up, it is negative for the equities market, but it is largely a negative sign if with yields going up, earnings takes a hit. But if with yields going up, earnings don't take a hit largely, then the three examples that we saw, equity markets don't react negatively. So I think what is more important, Sonia, is for all of us to keep an eye on whether or not with increasing yields, will earning really take a hit? If earning ends up taking a hit, then we probably might see equity markets reacting negatively. Otherwise, historically, like we've seen, if earnings are not taking a hit in a rising interest rate situation, I think that the equity market reaction to rising in yields is going to be very temporary in nature, and probably with a 3 or 5 year, it may not create a larger impact on it.
Okay, so, if this is the situation now, just try to explain to us how does one really approach equities and why has the above happened? I mean, in the sense, history teaches us that there could be two outcomes, right? Equity markets could do very well, as you rightly pointed out, or after a very good year, equity markets could peter off. But how do investors approach in this rising yield scenario?
So I think, look, Sonia, in my opinion, if you look, I'm not an analyst, but if you look at the Bloomberg analyst poll, right, there is a decent 14-15% rise in EPS that is getting discounted for in the market. Today, if you look at the price to earnings, of course, leaving aside the last 2-3 weeks downfall, we are still very conveniently and easily pricing in a 2023 earnings at the Nifty level. So in my opinion, if at all in a rising interest rate situation, if there are going to be some disappointments on the earnings front, probably this is not going to be a very good sight in the near term for retail investors. So my first suggestion to retail at this point in time while we are trying to invest is don't come into equities with anything less than a 3 or 5 year view, is because what you've seen over the last 24 odd months is probably very difficult in sight over the next 2 years. So if equity as an investment or an asset class has to be looked at this point in time, should definitely be looked at from a 3-year, 5-year perspective. Now, what can really work out for equities, in my opinion, probably 2-3 larger themes. Look, of course, interest rates are expected to go up, Sonia, but if you look at pre-pandemic versus today, repo is still close to 190, 200 basis points lower. So even if repo starts going up, interest rates start going up, there is a long way for repo to really go for it to reach to the pre-pandemic level. And historically, we've always seen that when rates are brought down very fast, but the rising rates is more staggered in nature. So of course, interest rates are going to go up, but the impact is going to be very slow. And I don't think rates are going to go back to pre-pandemic level. That's point one. And which is why I think versus pre-pandemic, rates are still going to be slightly lower, which is going to help capex and consumption. Of course, the China plus one theme that all of us know is also playing out. And I think both of these two things put together would probably maintain or help companies maintain earnings at their level. But of course, like I said, in my opinion, 2023 earnings are already priced in. And for that, if there is any disappointment on the earnings, market may not take it very swiftly. So coming to equity with a 3-year, 5-year view, and probably what we've seen in terms of return happening over the last 20 months may not really repeat immediately in the near future, Sonia.
Okay, so that's on the equities front, but rising rates have an impact on the debt market as well. It has an impact on gold. So I want to discuss that on the other side of the break. We have to take a short commercial break, but don't go anywhere. We'll be back with Smart Money in just a bit. Welcome back to Smart Money. Today we're talking about the rising rates globally and the impact it will have on asset classes. Now, theoretically, rising rates is negative for equities, but history has showed us that this is not the case. In fact, in the last many years, as Kirtan.shah, our guest, was just pointing out, despite a rising rate situation, the equity market has done well, and he says that this time will be no different. But now, let's talk about some other asset classes, fixed income, for example. Kirtan, tell us, rising rates is also negative for debt theoretically, right? So if one wants to, take up some fixed income as a part of their portfolio, how does one position itself in this rising rate environment?
So Sonia, like you rightly pointed out, rising interest rates would have a negative impact on debt. The logic is very simple. Imagine if you've invested in a fixed deposit today paying you a low 5% interest rate, and you lock yourself in for 3 years. And if interest rate starts to move up, you don't get the advantage of the rising interest rate, but because you're still locked in at the lower 5%. And that's how debt reacts negatively in a rising interest rate situation. So typically, the simpler way to position yourself in fixed income right now, if you're expecting interest rates to go up, is probably staying at the lower end of the curve. What I mean by that is try and invest in a way that the average maturity of your fixed income is much lower. Because how that helps you is the lower you keep the average maturity, at every maturity, when you are supposed to redeploy that investment, you probably might get a higher rate because the interest rate in the economy is going up. So one way of positioning yourself in fixed income, Sonia, right now is to keep your average maturities or investment time frame lower while you're trying to do fixed income at this point in time. And if there is somebody who wants to still stay invested in fixed income for a longer period of time in a rising interest rate situation, you typically do something called as barbell. What's a barbell? Barbell is a very simple strategy where you put 50% of your money at the lower end of the curve, right, which is lower maturities, and you put 50% of your money at the higher end of the curve, which is higher maturities. Historically, if you go back, you would see that every time yields have gone up, this particular strategy over a long term has really worked out well instead of taking position only at the lower end or the higher end of the curve. So if you want to keep it simple, stay invested in lower average maturities. Every time you will be able to redeploy the cash at a higher rate in a rising situation. But if at all you want to stay in fixed income for a longer period of time, then probably barbell is a better strategy to deploy.
Okay, so that's on the fixed income side. I also wanted to understand what should the good strategy be as far as gold is concerned, because gold has been rising as risky assets lose a bit of favor. At this point, somewhere around 47,000-48,000 rupees per 10 gram on gold. Is it still a good bet for the long-term investor?
Sonia, I think gold can be a very interesting proposition at this point in time, is because again, historically, we've seen gold brings in the diversification advantage. So if in the near term, while we are saying that because of policy rates going up, we might see some volatility in equities in the near term, gold will definitely have that advantage where money will move from a risk on mode to a risk off mode to gold. Of course, we've also seen that whenever there is a large debasement happening globally, and we've seen how Fed's balance sheet has ballooned over a period of time. So much of liquidity, so much of money getting printed also works in favor of gold, is because your traditional currency is losing appetite and value, is where a lot of money moves towards gold. And also, typically in a negative real rate environment, gold really does well. And we see all of these three cases that I pointed out currently happening or expected to happen over the next 2, 3, 4 quarters. And I think gold should definitely do well and should be a part of active portfolios if there is new money to be deployed at this point, Swami.
Okay, so I want to understand what are the key takeaways from this discussion that we had, and more importantly, we're getting a lot of queries on social media. So Kirtan, I wanted to toss one of them to you. You started by saying that this is still a good time to invest in equities with a 2 to 3 year horizon. Now, suppose there are new investors coming into the market and they have a 2 to 3 year time frame, and they're looking to invest through the mutual fund route. What are the top 2 or 3 mutual funds, both large and mid cap mutual funds, or even small cap for that matter, that you would advise them?
So I think, Sonia, like you rightly pointed out, I would sincerely suggest anybody who's looking at anything less than 3 years to not venture into equities right now. Come in with at least a 3 year, 5 year view. Look, in my opinion, while you are a newbie and trying to invest in equities, the first suggestion is try and follow an asset allocation depending on your risk appetite. Now, assuming that these things are taken care of, I think on the large cap front, I think I really like the 𝗦𝗍 large cap. Mid cap, I like the Axis mid cap fund. And on the small cap, I like the SBI small cap. I think these are my top 3 picks if at all somebody is looking at doing a large mid or a small cap investing, Sonia.
Okay, and since the hot topic of the season is exposure into these funds that have, an exposure in global companies, right? Global tech companies, the new technology companies, whether it's clean energy, whether it's electric vehicles, any of those funds that you like, and if yes, the top 2 or 3 that, stand out for you?
So again, Sonia, look, you can largely take exposure directly investing in NASDAQ through a lot of these ETFs or index funds that Motilal Oswal and Group and all of these other fund houses really have. But in my opinion, if at all you don't want to take a very large exposure to international equity or international investing, I think taking investment bet through a fund like a PPFAS FlexiCap fund, which would typically have a 25%, 35% exposure to international equities, and specifically on the tech side, would really solve your investment requirement at large. Because if at all from your portfolio you've allocated, let's say, 25% of your investment to a PPFAS FlexiCap, which in turn is investing 30% in global equities, a 7.5%, 10% of your portfolio indirectly gets exposed to international equities. That's one. And also, because this is a domestic fund, on this exposure of international equity that you are taking, you will still be taxed as equity. Unlike if you take exposure to any of these other products that I spoke to you of, internationally you will be taxed as debt. So I think if you want to take exposure up to 5-10% in global companies, take exposure through a domestic fund like a PPFX FlexiCap fund. You will get exposure also, and also at the same time your tax will work out to be more favorable for you, which is equity, unlike debt if you take direct exposure to international equities. Also, I feel some exposure to emerging economies like Taiwan, and also for that matter China, can also be taken given where global equities are at historical highs, where China is available at a 40% discount. I think maybe through an Edelweiss Greater China fund, you can really get exposure to China as well as Taiwan in the same basket. I think that is something also somebody can look at if at all international equity is something that is on your mind in terms of investments.
Okay, that's very, very helpful, especially, the list of mutual funds that you have given us. It's really helpful for our viewers, especially the new generation who's perhaps just entered into the market and wants to know how to find their fee. Thanks a lot, Kirtan, for joining us. As always, pleasure speaking to you. And it is an important week for us, right? We're celebrating our 22nd birthday on CNBC TV 18. So once again, to all our viewers, thanks so much for your patronage. Till we meet again, stay safe.